Alright guys, welcome back to WolfPackCryptos and MMGinvest. I am having technical difficulties. Apparently I cannot stream on two YouTube channels separately with the same IP. Because I scheduled a stream on the other YouTube channel, but that is apparently impossible. Alright, can you guys hear me? Alright, cool.
Protecting us from crime. Let's re-elect him to...
Alright, so first of all, this is not financial advice. This is more of an educational channel. Once this video is uploaded, it's pretty much obsolete. Cryptocurrencies, equities, anything on the markets is essentially very volatile, very risky right now. If you do anything, I suggest you place stops, have emotions out, and know what you're doing if you're even going to attempt to trade. If you're a long-term investor, this is more of information to see the macro trends for you guys. Alright, so the Dow, the S&P, all of the markets had a small rally, a bounce today, this morning on the open. I wasn't even going to go live during the open because the markets are extremely volatile in the first hour of trading, and that's for day traders. So the smoke is cleared, and we're going to take a look at what's going on. I'll also talk about like the news and macro events and whatnot. Let's take a look at the Russell 2000 and NASDAQ, because I feel like they are leading the markets. I mean, there's a small bounce on both of them, but that doesn't mean that the market's done falling, right? Here's the daily. I mean, it's finding support right where I thought it would. Down in this area, there's a lot of buyers. But tomorrow is Friday, and it's Take Back Friday. We'll see if this is just a dead cat bounce for now. And you can buy this dip, right? The problem is you don't know what's going to happen overnight in the foreign markets. Alright? And you don't know if it's going to open even lower the next day, and that's the risk. Also, I wouldn't hold any equities over the weekend. Not yet, at least. For the market to recover, like, to have confidence that the market's going to recover, you need the price going back above, and this is the Russell 2000, smaller cap companies. You need the price to break back above 1600. And even if the price gets back up there next week, it's not going to happen today or tomorrow. It's probably going to pull back before it breaks out, because this will be major resistance up here on the Russell. And, you know, all of these equities are going to look the same. NASDAQ doesn't look as bad, but again, there's support. A lot of buying happened back earlier this year in this area. So the NASDAQ could fall. It has more room to fall than the Russell. but it could bounce early, giving us a higher low from from earlier this year. If the markets start recovering next week and the price doesn't dump tomorrow. This is a daily chart of the NASDAQ 100 E-mini futures. So there is some buying coming in now, but we'll have to see what happens next week. Of course, if the midterms, right? I've said this. If Trump stays in power, I expect a recovery. I don't. Will it go to all-time highs? That's not certain, right? We could see in the next few weeks a recovery, but not quite hitting all-time highs on equities because there's resistance now up at the all-time high and a little bit before it. So this area right here between these two purple lines, that would be resistance up there. Major resistance. All right, so I am not trading all that much in the equities right now because it's extremely volatile. And I know there's stocks that are pumping and dumping, and that's based on earnings. And you could do that, but I'm not going to talk about those because I don't think most of you guys would be able to navigate in such volatile markets. You have to be really quick. Like, there is no signals or alerts or anything like that when you have choppy volatility like this. And most of you guys are hedging with silver and gold and metals, and that's a macro trade, long-term trade, right? So let's take a look at metals. I did talk about this, right? This is the gold to silver ratio. Once it hits 84, so 1 ounce of silver is 1/84th the price of gold. So 84 ounces of silver equals 1 ounce of gold, right? And a lot of gold bugs keep talking about this because let's say 1999, that's when the bull market really started in metals, or early 2000s. You could say 2004, 2003. And so let me show you. Hold on. Here's the weekly chart of gold. Or no, this is actually silver. I mean, that's fine. Silver tends to lead gold half the time. Depends. I mean, it depends. They flip-flop. So here's silver, right? It broke out in 2003. Towards the end of 2003, as you can see right here. This looks very similar to Bitcoin, right? It's that bubble chart. And at the all-time highs, it was $50 an ounce. Currently, the price is at 14.6 on the futures. There is a premium, of course, when you're buying physicals. So it broke out in 2000 and the end of 2003, the price of silver, and so did gold because they trade together, right? They're both considered safe havens. And the ratio, right, to gold and silver was 84 at towards the end of 2003. So you can see every time that the ratio hit 84, it caused a massive rally. And then the second time, it was in 2008, right before the mortgage-backed security crisis, the ratio hit 84. You can see on silver here in 2008, it took off again. It was a huge dip, oh no, here's 2008, the start of 2008. So it rallied in the beginning of 2008 when the financial markets started having signs of struggling from the mortgage-backed securities, right, that were crashing. Lehman Brothers and Fannie Mae, Freddie Mac, and all that. And then gold and silver crashed together with the stock market and then took off into a giant bull market, right? But what I'm trying to show you is that 84 ratio silver to gold was right around this area when silver took off. And that would actually show on the ratio that it dropped. So when silver took off, that ratio dropped right here. Well, no, right here. So the ratio went up to 84 prior to that rally in 2008, and then it dropped as the market dropped as well. Now, at the all-time high in 2011, when gold and silver had their all-time high, gold was around $1,900, silver was around $50 an ounce. The ratio dropped to historic lows of 32 to 1. So it only cost 32 ounces of silver to equal the price of 1 ounce of gold. And that was at the all-time high. So again, and then in 2016, well, let me show you so you guys don't get confused. So here's the all-time high, right, of price of gold and silver, and the ratio dropped all the way down. So here's silver, and at its all-time high, that ratio dropped all the way down. In 2016, the ratio went all the way, we had this huge rally in that ratio, right? And this was during the entire bear market from 2011 to 2016. Then we had the first rate hikes by the Fed. And then the ratio was at 84 again in the beginning of 2016. And what happened in 2016? Here's 2016. There was a nice rally for half that year. See that? And then the ratio was up here prior to that rally. So again, we are at 84. We're up here. And here's the price of silver all the way down here, very close to not all-time lows, but within the past decade, I mean, it's close to all-time lows. The last time we saw prices this low was in 2015, the end of 2015, before the rally in 2016. So you can see that there's a huge support on silver right here, where I put this white line. And I don't think this is going to break due to just fundamentals. Fundamentals in the cost of mining and the fact that the metals have been suppressed for so long that the supply really isn't there. Now, here's what's contradicting. If the stock market recovers fully after midterms, let's say midterms, Trump stays in power, cuts more taxes, everyone starts buying back equities, and we go higher and we make new all-time highs, then then will metals fall further? I don't think so. I think they'll just hover around the prices where they are at right now. Not just that, for the stock market to recover, it's going to take time. It's going to take weeks and months. It's going to take some time into 2019. I still expect the market to trade sideways even after the midterms and consolidate again, and then it'll move up or down. And that could take us into 2020. And you can see that happened the beginning of this year. Well, it might not take us into 2020, but it'll take the rest of this year and into 2019 to see where this market is going to end up. As you can see, it consolidated and then broke out. I expect the same thing. It's not going to shoot straight up. And then we will see where it ends up. New all-time highs, or fundamentally and geopolitically around the world, things could change and economic data could change. Also, the Fed, what's the Fed going to do while the markets consolidate and make a large move, right? Because everything happens in fractals. Every time there's a sell-off like this, it's going to take some time for the market to figure out what it's going to do next. Another example. Now, here's what's interesting. In 2016 and 15, we had sell-offs like this, right? And they recovered fairly quickly. But here's what I'm thinking. I'm thinking that it's not going to recover as quickly because a lot of people are already in the market. So where's the extra capital and cash going to come from, right? Because the Fed is tightening. That's the problem. The Fed's tightening. The Fed started tightening back here, but there was still money being injected into the markets because the interest rates were still low. And the fractional reserve lending through the banking system creates more money, even though the Fed stopped printing because of low interest rates. So, if the Fed, let's say, capitulates and stops raising rates, I think the market could go a little bit higher and go to all-time highs. But there is also other things in play, right? The tariff war with China. If Trump makes a deal with them, that would probably send the markets higher, and the Fed becoming dovish would also help. And if that happens, I think metals will just trade sideways for some more time. We'll see. But it's too early to tell right now, right? This is a daily chart, by the way. Here's the federal surplus versus deficit, right? So for the US, you can see in 1998 and in 1999, the federal budget was not in a deficit. It was actually in a surplus. And then after 2001, with all the wars and whatnot, the deficit has just been growing and growing and growing. Now, in 2009, after the mortgage-backed security crisis, the deficit hit an all-time low. Or no, not a low, but all-time high. And what that means is the government was spending way more money than it was collecting through taxes. But if you look now, the deficit's pretty bad right now, and it's trending down. This is also very bad. So Trump cutting more taxes is just going to cause the deficit to worsen. And like I said, you cannot have tax cuts without cutting the size of the government. So you can't have both. You can't have what's that saying? You can't have your cake and something else too. Um, but yeah, Trump's gonna have to cut federal jobs and state and local. You have to cut the size of government all around if you're gonna keep giving tax cuts. You can't have both because how's the government gonna fund itself? Well, the obvious answer is the Federal Reserve. It's going to keep printing money, but that'll be the cost that'll cost the dollar its value, right? Right now, the dollar is still high. It's still holding on because international problems with emerging markets, and it's the flight to safety. It's the initial flight to safety. Will the dollar break out? There's major resistance on the dollar at pretty much at the 97 handle. Major support back down at, you could argue, the 95 handle. So this would be this is a daily chart, major daily chart. So looking at a long span of time for the next year or two. This would be neutral for the dollar. So as long as the dollar trades in here, that's really good for the U.S. economy. If the dollar breaks out, that is signaling that emerging markets and the rest of the world is really struggling, and their markets are crashing, and the dollar is a safe haven. And once the dollar breaks below this 95 handle, that's telling me that the Fed has capitulated and is printing more money to save the stock market, the banks, and the financials, and the federal government and its spending, right? And that also signals that the world is selling the dollar, and the dollar is losing its hegemony, its world reserve currency status. So we can see that play out with the dollar. And the yields are still above 3% on a 10-year treasury. So the interest rates. So when the market dumps like this, that's good for the main economy short term because interest rates fall, and the debt on your home mortgage and your cars and loans fall, right? And people could keep making their payments. But this is, a knee-jerk reaction and it's short term because I could see interest rates going higher and higher as the market keeps falling. At the same time, the Fed's going to come and try to save the day, and they're going to lower interest rates and to artificially prop up the stock markets and the banks and everything else. It's a real sticky situation for the Fed and the economy as a whole in the U.S. There's just so many things that are moving around and they're contradicting each other, and it's a real balancing act. So here's the yield curve. I haven't shown this in a few weeks, and I've shown this before. So here's 2001, right? Here's the yields, the interest rate, the yield on it, on treasuries, on U.S. debt, all the bonds. The short-term treasuries are in the front here. The longer term, the 20-year, the 30-year, and the 10-year are in the back. When this red line inverts, where the short-term interest rates go higher than the long-term, that signals a recession is coming, or a depression, or crash is coming. So let's take a look at how this plays out over a 10-year span from 2000 and let's say 2000 to 2008, when right before the mortgage-backed security crisis, right? So here's the yield curve, right? You can see it's dropping. The short-term rates, the long-term rates stay the same. This is 2003, 2003 still, 2004, 2005, 2006, 2007, and now it's 2008, right before the mortgage-backed security crisis, as it's playing out. And then, but you can see that it inverted right here, right? Even though Alan Greenspan kept interest rates lower than naturally, organically, right? It does peg this yield curve sorta to the ground down here, and I'll talk about that in a second again. But you can see that it inverted, right? The short-term interest went above 4 and 5%, while the long-term was below the short-term interest. And then the market crashed, and then it normalized, right? Where the long-term bonds, so if you buy a bond for 30 years, your interest should be higher, right? Well, and that's normal, where your long-term bonds, the interest rate is much higher on them, the yield, than your short-term, because you're holding that debt longer. You're holding government debt longer. So the longer you hold something, the larger the possibility that something could go wrong, right? And not just that, it's a long time. So you want a higher rate of return for your loan to the government. All right, so let's go from 2009 to current time, right? Let's see if the yield curve is inverting. It's 2011, 2012, 2013, 2014, 2015, 2016, 2017. So this is 2017, 2018, coming towards the end of 2018 right now, and this is current day. Now, you can see it's not inverted, but it's flattened out, the yield curve. Now, the reason this isn't completely flat is because interest rates are artificially pegged to 225 basis points. That's the federal funds rate. That's what the Fed plays around with, is interest rates, right? And that constitutes, that controls the money of the flow of money through debt issuance by fractional reserve lending from the banks. But they've pegged it to 225. They have been raising rates for the past 2 days, but very, very small, tiny amounts. And right now, the yield curve is flattened. So that's what the yield curve is telling us. And it's pegged, right? Now, if the Fed starts lowering interest rates or stops raising interest rates, it keeps the yield curve pegged. But it's like, it's not showing, the yield curve becomes an indicator that isn't true anymore because it's being manipulated by the Federal Reserve, right? So, but you could guess, right? If the long-term yields keep falling and the markets force short-term interest rates higher, which the markets can override the Fed, then you know a recession's coming. So right now, the yield curve is not really, it's not signaling a red that a recession's coming, but it's sort of like a yellow light, right? So you have you're driving your car and you get that yellow light before the red light, right? It tells you to slow down. We're pretty much, the yellow light just turned on. That's how I view it. And when the yield curve inverts, you have like 3 months, 8 months, but you never know. I mean, investors might see the yield curve invert and they'll sell early. So when the yield curve inverts, that's signaling red, that the economy it's going to have a recession. Let's look at some news. Or what's this? Yeah, it's all green today. Europe also, their markets closed in the green. a few hours ago. Let's look at the world. This is the past 24 hours. China's all in the green today. So is Europe. Canada not doing too hot. Let's talk about real estate. Thoughts on China and Russia dropping the dollar? Well, I've said, like, the U.S. has used the dollar and the SWIFT system to punish Russia and China when they're not doing what the U.S. wants, or they're not having fair trade deals, right? And so it would be in their best interest to stop using the dollar because it's bad for the U.S. And then the U.S. loses control over them. Everything's frozen. Hold on. I just closed that window. That's great. So, you know what? I'm going to post these articles in the MMGinvest chat room on Telegram. And it's free. You guys could all join in there. And you guys can read these articles. I don't want to make this a 2-hour long video. I have a lot of research to do. Alright, guys. And join this chat room as well. Join the MMG YouTube channel. Just type in MMGinvest. And I'm going to try to keep things separate because it gets way too confusing if my WolfPackCryptos YouTube channel has, you know, metals and equities on it as well. And I'm going to just keep them separate. I'll post everything in the Telegram group. So I'll post MMG videos in the Telegram of the cryptos, and I'll post the cryptos and the MMGinvest videos in the MMG chat rooms, all right? There is a private room to MMG, but that's not open to anyone yet because I need to finish doing research on gold and silver and metals stocks. Also, the WolfPackCryptos private membership is separate from the MMG. The MMG is not going to be like a trading room or anything like that. It's just fundamental research on metals stocks and some commodities and some energy stocks and some staple stocks. I'll add those later on. It's just I have to get the website up for the MMG. Alright, guys. Also, share and like this video. Subscribe to WolfPackCryptos. Subscribe to MMGinvest as well. The links are all below this video, alright? Let me answer some questions. There's a lot of questions before I go. I should probably do Twitch live stream. I have no idea how to use Twitch. I've never used Twitch. I'll check it out though. Thank you. Why did silver go down? Because the stock market went up today. And so did gold. They went down. I didn't even put on a position yesterday in metals. My long-term holdings are just long-term. I'm gonna hold my stocks. Those I just don't touch, and I just let them ride. Also for tax purposes, right? The VIX will be high for a while. I don't know. I think the VIX will drop. Well, yeah, you know what? I know what you mean. the VIX is going to be very volatile. It'll be moving up and down as the S&P 500 and the rest of the stock market consolidates in this wedge, right? So the VIX will be probably great to trade for day trading and possibly swing trading, holding for a couple days. And I love trading the VIX because it moves so much. It's very volatile, but you have to know what you're doing, right? All right, Tedward. My theory is the stock market won't completely crash until the central banks are ready for a cashless society transition. This will be the mother of all crashes. Don't let it go to waste. Well, absolutely, this will be the largest wealth transfer in our lifetimes and in the history of humanity, right? So if you're not on this wealth transfer, I mean, you're missing out on the biggest opportunity of your lifetime, and I think the wealth transfer is cryptos and metals, and they're not going to let the markets crash until we go to a cashless society. I mean, possibly they will probably roll out a cashless society as everything crashes, but and and that takes us to cryptos. That would probably make cryptos go higher, right? And I do have that conspiracy video of Circle, controlled by Goldman Sachs, and they're creating that stable coin where they could get everyone onto a stable coin. Then we have Ripple as well, and So there's a reduction of 85 to 90% of U.S. treasuries in the past 2 to 3 years. Well, yeah, China and Russia are just dumping and letting their American debt mature. The question is, who's buying it? I mean, China's going to let it mature because they don't want the U.S. to fully implode because China's biggest customer is the U.S. Not so much anymore with these tariffs, right? So I'm surprised everything's holding up as good as it is with this global trade war. How long can we keep kicking the can down the road? I don't know. I really don't see it going past 2020. I mean, maybe this is the top of the market right now. And this is it. The S&P almost hit 3,000. I mean, this could be it. And the market might trade sideways for months and months, and then it'll just break down, and there you go. Although, let's take a look at the 2008-2009 crash. We'll go to a weekly chart real quick. There we go. See how... See how this played out? So, when the market topped out in 2007, that's actually when it topped out. It took it some time, the market, to calculate in that this is it. Party's over. The stock market's gonna tank. And the mortgage-backed security crisis isn't isolated to the home market, and right? So this was 2007 all-time high, and then it dropped, and it's very similar to the current 4-year chart. So you could almost say this was 2016. The Fed started raising rates. And then we had a nice dip. Right? And this was the beginning of this year. And then another dip. and then the markets try going to all-time highs again, thinking everything's all right. Then all of a sudden, the fundamentals and corporations and banks started having trouble. They were starting to go bankrupt, and then all of a sudden, boom. And the bear market, it went from October 2007 all the way until March of 2009. So the bear market started in 2007, the recession, the Great Recession, and it lasted until March 2009. I think this one is going to play out similarly. It's the market's not going to keep dropping. It might not happen. What I'm trying to say is the markets might not crash within weeks, all right? And they drop like 50% and there's just nothing below the market. It might play out. It might take a couple years for it to play out, which is actually the best case scenario for making money and for the wealth transfer with cryptos and precious metals. I hope the market just doesn't straight drop like like 1930, like the 1939, crash. So what I just showed you guys, right? This is very similar. You see this right here, 2016 dip. The Fed started raising rates, and then we had two major dips at the all-time high in 2007. Let me bring you back. So keep this in your mind, this picture, right? So this is the past this is the past 3 years, past 4 years, right? We had a nice dip. Fed started raising interest rates. Then we had two dips. Right now, we're in the second dip arguably at the all-time high, right? Let's go back to 2007. So this would look similar to it, right? We had that dip. Fed started raising interest rates. Then we had another dip and then another dip. And then you could arguably say we are here today, which used to be 2007. And then the market rallied again, went to all-time highs, and then it dropped. This is actually what I'm hoping is going to play out. That the stock markets will recover, go to all-time highs, and then we finally go into that recession bear market in like 2020. But this is speculation. I'm just theorizing. I'm not saying this is going to happen. I'm just hoping that does. It plays out just like in 2007. Markets don't rhyme, but markets don't repeat, but they tend to rhyme. What coins are good for mining? I have no idea. I don't mine coins. We don't really specialize in that type of stuff. There is one coin I want to mine, but I just don't have the time. And yeah, I mean, guys, I can't give you, like, anyone out there on YouTube or anywhere else telling you they know what is going to happen is just complete crap. Nobody knows what's going to happen. If people knew what's going to happen and they could time things perfectly, they would be billionaires and they wouldn't be sharing their thoughts with people, right? Like, I accept the fact that I don't know. I let the market tell me on the short term what's going to happen. Like, I just showed you guys weekly charts. Like, there's no way I'm going to, like, I could perfectly time everything and know everything. Because nobody knows what's going to happen in the world. You don't know if a war is going to break out. You don't know, you know what I mean? You don't know how the trade war is going to play out. You don't know politically how things are going to play out. I am betting, like, I'm just guesstimating that, that Europe's going to fall before US. I'm guesstimating the midterms are going to keep Trump in power and the market's probably going to recover. I'm guessing, okay? Looking at probabilities, looking at the news and all that. But there's no way. trading is like a short-term thing. Like you could trade based on I mean, no, you could trade long-term as well, right? But you always have stops in place, and things change. And the trading is more about strategy and knowing what to do when things change, knowing when to get out. All right. And with equities and the traditional markets, I mean, the only thing I'm willing to say is I am long metals and I'm okay holding them at a loss for the next 2 years. And on the side, I do trade equities, and I make extra with that, and then I keep accumulating for the long-term play. And the long-term play is shorting the U.S. stock market. And the way I'm shorting it is buying metals because it's a wealth transfer. And I don't like, shorting because you could get, especially with margin, you could get liquidated quickly. I've learned my lesson shorting. But I never say you should short the stock market or anything like that because that's for professionals, all right? And professionals don't have time to watch my YouTube channels, to be honest. All right, guys. All right, more questions. I mine for future profits. If you mine to sell immediately, then you're screwed. Yeah. So, well, yeah, if you're mining, you're betting on the fact that cryptos in the next few years are going to be at all-time highs, right? And yeah, there are a few that you could mine, and those coins will likely be around in a few years or a few months from now, right? And, my research, I star them. I give them a star rating from 1 to 5 based on my data. And the ones that are 5 stars and you can mine and they have good payouts, and they, especially if there's, if there's a good payout on it, right? Interest on mining, and the cost of mining is very low, then yeah, I mean, that works out for a lot of people. I just don't have the time to run a miner. And I'm not even that, like, tech savvy. I just don't have the time. What is better, buying metals physically or opening an account backed by metals? You mean backed by physical metals, like gold money? It's partnered with Peter Schiff. Um, well, you always have that third counterparty risk when you open an account. But, if someone breaks in your home or finds your stash, that's also a risk. I say do both. I do both. Stocks are way more risky, but the upside potential is much higher. So if, gold goes to 10,000 an ounce, your stocks are going to go up like 10,000% or more. If gold goes to 50,000 an ounce, which I don't know if it's going to do that. Some people are saying it will. They say if the world goes back to a gold standard, it will be $50,000 an ounce. I mean, your stocks, your gold mining stocks are just going to go literally to the moon. So Ray Dalio was saying that the market cycle, the bull market cycle will end in 2 years. And, it's kind of what I'm thinking as well, but the savvy traders and investors, whenever they hear something like that, they'll take profits even sooner. Let's face it, everyone knows that the stock market's overvalued. Everyone at this point is just speculating and smoking that Trump hopium, and they're thinking Trump is gonna really boost the economy in the next 2 years. All he has to do is stay in power after the midterms in what, 2.5 weeks from now. So yeah. You live in Sweden? What do I use? I don't know what to tell you. I mean, you could go international, and I don't know. I don't want to talk about that. I don't want to give bad advice, right? I personally use gold money. Uh, that Peter Schiff's involved with. Yeah, I don't know what to tell you for Sweden though. Because I don't know what the regulations are in Europe, and I know they're some are more strict, some are not. All right, guys. I don't really see too many more questions. Thought on Forbes' new crypto site. Forbes has a new crypto site. Everyone has a new crypto site. Preferred stablecoin. I don't know. They're all risky, right? True USD is less risky than Tether because of all of the FUD and the fact that Tether will not get audited. And Tether has lost one of their banks or something. I don't know. It's just True USD is less risky than Tether. Tether is more risky, right? But they're all risky. And the USDC, the Goldman Sachs Circle, stablecoin. I mean, I just made a video on that. How the, I'm not using that. They could just freeze your funds and take everything. I'm not doing that. The backed. Okay, well, I'll talk about. I talked about cryptos in my last video. Will backed be approved? And I think it'll be approved. And we'll see what the ETFs. I don't for sure know, right? But I am more positive on the ETF and the backed. Now, will money flood in the day backed opens? Probably not. It'll probably take weeks, maybe a month or two, for institutional money to start flowing in. We'll see. I think if the market, if the equities stock markets trade sideways, maybe speculators will start looking at cryptos. So we'll see. Alright guys, I gotta go. This video's been long. It's almost an hour. Give me a thumbs up, share the videos, and all that fun. Check out the MMG chat room and the MMG YouTube channel. I couldn't go live on there today because streaming live with the same accounts is apparently not possible until I figure it out. Until next time.